You know what shocks most people? Debt. Some fear it like it's the ultimate financial monster, while others treat it like a best friend they can't live without. But here's the truth. Debt isn't just black or white. It can be dangerous, yes, but it can also be one of the most powerful tools you'll ever use to build wealth if you understand how to play the game. Think about it. In America, there are two extremes. On one end, you've got the debt crusaders, the people who cut up their credit cards, avoid loans like the plague, and believe the only way to become rich is to live completely debt-free. Then, on the other end, you've got the people who finance everything. Vacations, luxury cars, even day-to-day living. They carry credit card balances month after month, bleeding money on interest, and driving around in cars that are nothing more than shiny cages of financial stress. But what if I told you there's another way? A middle ground where debt isn't your enemy, but your ally. A way where, instead of debt crushing your future, it actually works to build your financial empire. Here's the secret. Not all debt is the same. Some debt is poison and will drag you down no matter what. Other debt, if managed correctly, can actually accelerate your wealth. And the key to unlocking this? Understanding the difference between high-interest debt and low-interest debt. So, let's break it down. High-interest versus low-interest debt depends on two major factors. Your age and the type of debt you're carrying. Why does age matter? Because the younger you are, the more time your investments have to grow. That means you can take advantage of long-term compounding returns. But not all debts are created equal. Some must be destroyed immediately, while others might actually be working in your favor. This is why, in the financial order of operations, what we like to call the FOO, high-interest debt comes first, even before most investing. Low-interest debt? That comes dead last. And the reason boils down to one powerful concept: arbitrage. Here's how it works. Imagine you're carrying credit card debt at 20% interest. Even if your investments are earning 10% a year, you're still losing money. That's a guaranteed 10% loss annually. But flip it around. If you have a 4% mortgage and you're earning 10% on your investments, that's a 6% positive gain in your favor. That's the power of arbitrage. It can work for you, or it can destroy you. So how do you decide whether to pay off debt or invest? You need to understand two more concepts: the risk-free rate of return and the risk premium. The risk-free rate is what you could earn with essentially zero risk, like US Treasury bonds. Right now, that's about 4%. The risk premium is the extra return you expect by taking on risk, like investing in the stock market. Historically, the S/&P 500 has averaged about 10% annually, meaning the risk premium is roughly 6%. Put these together and you get a simple rule. If your debt interest rate is higher than the risk-free rate plus the risk premium, you should pay it off as fast as possible. But if your debt rate is lower, investing might actually be the smarter move because you're capturing a positive arbitrage opportunity. But here's where it gets interesting. Not all debt fits neatly into this rule. Everyone's financial situation is different. So let's break down the big four debts: credit cards, cars, student loans, and mortgages. First up, credit cards. Without a doubt, these are high-interest killers. They're almost always a bad deal. With interest rates often around 20% or higher, no investment can realistically beat them. Add in the hidden fees and penalties, and it becomes a financial chainsaw ready to slice through your future. In the financial order of operations, credit card debt is treated like an emergency. It must be destroyed as quickly as possible. Next, car loans. A little trickier. Cars lose value the second you drive them off the lot. 10% gone instantly, and about 60% gone within 5 years. That means financing a car can be a financial trap if you're not careful. While it's always best to pay cash, that's not realistic for everyone. That's why there's the 20/3/8 rule. Put 20% down, finance for no more than 3 years, and keep payments below 8% of your gross income. Now let's talk about student loans. Unlike cars, they don't depreciate, but they can still crush you if not handled wisely. That's why we use the first-year salary rule. Your total student loan debt should not exceed what you expect to earn in your first year out of school. Finally, the big one: mortgages. This is where debates rage the hardest. Some people want the peace of mind of paying off their mortgage early, while others focus on maximizing long-term returns. Here's our view. Mortgages are generally low-interest debt. Why? Because houses appreciate in value. averaging around 3.8% annually. And unlike credit cards or car loans, your mortgage interest rate is fixed, and you can refinance later when rates drop. Let's run the numbers. Suppose you've got a $300,000 mortgage at 7% for 30 years. Your monthly payment is about $1,995. If you throw an extra $500 at it every month, you'll pay it off in 17 years instead of 30. Not bad. But here's the kicker. If you took that same $500 and invested it for the full 30 years, assuming a 10% return, you'd end up with over $1.1 million. That's the power of compounding. Paying off the mortgage early saves money, but investing that extra cash creates far more wealth in the long run. So here's the bottom line. Debt isn't automatically bad. By understanding your age, the type of debt, and the interest rates involved, you can create a strategy that puts your money to work for you. Destroy the high-interest killers first. Use low-interest debt wisely. And remember, the ultimate goal isn't just to be debt-free, it's to build wealth and freedom. Because at the end of the day, debt is either the anchor that drags you down, or the lever that catapults you into financial independence. The choice is yours.